There's a secret weapon that the wealthy use to build their fortunes. It's called compound interest. This is not a concept reserved for the affluent or financial wizards, but an accessible tool for anyone who wants to grow their wealth. But what exactly is compound interest? Imagine it as a snowball rolling downhill. At first, it's small and gathers little snow, but as it continues to roll, it collects more and more snow, growing larger with every turn. Similarly, compound interest accumulates over time, increasing the size of your investment or savings. Now let's compare compound interest to its counterpart, simple interest. Simple interest is like a flat field where your snowball can't gather any more snow. It remains the same size no matter how long it rolls. It's a one-time thing, calculated only on the initial amount you've invested or loaned, known as the principal. Compound interest, on the other hand, is dynamic. It's calculated not just on the principal, but also on the interest that has already been added to that principal. It's interest earning interest. Let's paint a picture. Say you have $1,000 in a savings account that earns 5% compound interest annually. After the first year, you'll have earned $50 in interest, bringing your total to $1,050. Now, in the second year, your interest is calculated on this new total. So you'll earn $52.50, not just the initial $50. This might seem like a small difference now, but over time, these small increments can lead to substantial growth in your wealth. The key to maximizing the benefits of compound interest is time. The longer you let your money grow, the more significant the compounding effect. So, compound interest essentially means earning interest on your interest. It's a powerful tool for growing wealth. It's not a magic trick, nor a get-rich-quick scheme. It's the science of money growth, a steadfast ally in your journey to financial freedom. Remember, the snowball only grows if it keeps rolling. Don't forget to like and subscribe. Compound interest might seem like magic, but it's actually rooted in mathematics. It's the secret sauce that makes your money grow faster over time. But how does this magic work? Let's break it down. The formula for compound interest is quite simple. A equals P times 1 plus R over N, all to the power of N times T. Sounds daunting? Don't fret, let's simplify it. A represents the total amount of money you'll have at the end. P stands for the principal, or the initial amount of money you start with. R is the annual interest rate in decimal form. N is the number of times interest is applied per time period. And T is the time the money is invested or borrowed for in years. Let's paint a picture with a hypothetical scenario. Suppose you invest $1,000, that's your P, at an annual interest rate of 5%, your R, compounded quarterly, so N is 4 for 10 years, your T. Using the formula, we find that at the end of 10 years, your $1,000 would have grown to approximately $1,648.65. That's $648.65 more than what you started with, without lifting a finger. But here's where the magic happens. The interest you earn in the first year gets added to your principal. So in the second year, you're not just earning interest on your original $1,000, but also on the additional interest. This process repeats every year, and with each passing year, your money grows exponentially. The more frequent the compounding, the greater the amount of compound interest. So quarterly compounding will give you more money than annual compounding, and that's the magic of compounding. It's not just your money that's working for you, but also the interest that your money is earning. So, the next time you think of compound interest, don't think of it as a complex mathematical concept, but as an ally in your journey towards building long-term wealth. Compound interest is a long-term game. The longer you allow your money to grow, the greater the power of compounding. Let's delve into the time factor, a vital component in the equation of compound interest. Now meet John, who starts investing at the age of 25, and Jane, who begins at 35. Both invest the same amount of money annually and earn the same rate of return. However, by the time they reach 65, John has a significantly larger portfolio. Why? Because he gave his investment an extra 10 years to grow and compound. So what's the takeaway? Start as early as possible. The benefits of starting to save and invest early cannot be overstated. It's not just about how much you invest, but also about how long you let it grow. Now you might be thinking, but I didn't start investing early, is it too late for me? Absolutely not. While it's true that starting early gives you a significant advantage, it's never too late to start. The key is to start now, no matter your age. And remember, it's not just about saving and investing, it's letting your money work for you over time. understanding that the time factor in compound interest is your greatest ally. So, whether you're just starting your journey to financial independence or you're well on your way, never underestimate the power of time. It's the secret ingredient that can turn a modest investment into a substantial sum. Remember, time is the most valuable asset when it comes to compounding. The sooner you start, the better. Let the power of time and compound interest work in your favor to build your long-term wealth. You now understand the power of compound interest. But how does it fit into the bigger picture of wealth building? Let's dive into the heart of it. Compound interest is a fundamental pillar in the grand structure of long-term wealth. It's the secret weapon you've been looking for, the hidden key that unlocks the door to financial independence. It's not some random lottery win or an elusive pot of gold at the end of a rainbow. It's a systematic, calculated approach to growing your wealth. Imagine this. You're a sculptor, and each dollar you save is a chisel strike, slowly but surely shaping your financial future. Compound interest is like the momentum of your chisel, multiplying the force of each strike, accelerating the transformation of a mere rock into a magnificent statue. But remember, Rome wasn't built in a day, and neither is wealth. It's consistent savings, smart investments, and above all, patience. The beauty of compound interest is that it works best when given time. The longer you leave your money invested, the more compound interest works its magic, turning small, regular savings into a significant sum. Yet, it's not just about sitting back and watching your money grow, it's discipline. Resisting the urge to dip into your savings for immediate gratification, understanding that the future reward is worth the present sacrifice. So, if you're wondering how to become a millionaire, there's no secret handshake, no hidden treasure map. Instead, it's a code. A code built on the principles of compound interest, regular savings, smart investments, patience, and discipline. For more info, don't forget to click the links in our description box below. But remember, this is just a guide. Your journey to financial independence is unique to you. It's a journey that requires understanding, commitment, and a clear vision of where you want to be. It's all about making your money work for you and building wealth for the long term. So, take this knowledge, apply it, and watch as your financial future transforms before your eyes. We've unlocked the Millionaire Code. Now let's talk about how you can apply it to build your own wealth. Building long-term wealth isn't a magic trick or a get-rich-quick scheme. It's a calculated, strategic approach that leverages the power of compound interest. Remember, compound interest is your money's best friend. It's the fuel that drives the wealth-building engine. First, let's talk about diversifying your investments. It's like not putting all your eggs in one basket. When you diversify, you spread your investments across various asset classes, such as stocks, bonds, real estate, or even startup ventures. This strategy allows you to reduce risk and increase the potential for returns. Next, let's discuss the importance of reinvesting your earnings. When you earn interest or dividends on your investments, don't just pocket that money. Plow it back into your investments. Reinvesting your returns allows you to buy more shares or units of your investments, which in turn produces more earnings. This cycle of earning and reinvesting is what generates compound interest and accelerates your wealth accumulation. And then, there's the long game. Staying invested for the long term is crucial. While it's tempting to jump in and out of the market trying to time it perfectly, remember that time in the market is generally more beneficial than timing the market. The longer your money is invested, the more time it has to compound and grow. Building long-term wealth is a journey, not a destination. It requires patience, discipline, and a solid understanding of financial principles like compound interest. But once you've unlocked the Millionaire Code, the path becomes clearer. And there you have it. The Millionaire Code, building long-term wealth. Compound interest is your secret weapon. Use it wisely and watch your wealth grow. You can do it. We believe in you.